Hello, in this presentation, we're going to take a look at the customer section, the sales section, or the accounts receivable cycle within QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in the QuickBooks Online dashboard. We will be continuing with the Get Great Guitars problem. We're going to go over the accounts receivable or the customers or the sales cycle. This is going to be the process dealing with the sales to customers and those things that will be involved in that process. To do that, we will be going up here to this item and looking at the customer section, as well as going over to the sales item on the left side. Before we do that, however, we're going to take a quick look at the QuickBooks Desktop version for a couple different reasons. One is that some people might be used to seeing the home page on the desktop version, and two, whether you're used to that or not, it's a really good flow chart so we can see how these things fit together in a flow chart, and then look for those same items here within QuickBooks Online. The same items will be in both locations, but it's nice to see the flow chart to see how QuickBooks will put these things together and how these cycles typically work. So this is actually a QuickBooks Online homepage, and the homepage is broken out by cycle, which can be very useful to us. So we're just really, for the QuickBooks Online course, we're just looking here at what the QuickBooks On Ground or desktop version shows for the flow charts, and it breaks those up into relevant categories. So we got vendors, customers, and employees. When analyzing what is going on, it's nice to see this little flow chart and see what is happening. Once we get used to this flow chart, we don't really need it anymore, but when we're first visualizing things and seeing how the process is going to work, it's good to have a visual demonstration of that. We here are going to be concentrate on the customer section, and when you're thinking about the customer section, there are people working in the accounting department that work pretty much all the time in just one of these cycles. So when you think about the accounting process, we don't really want to think of it too much as just totally chronologically. We could, but it's probably easier to remember things happening within cycles. So we looked at the vendor cycle before. Now we're looking at the customer cycle, which could also be the accounts receivable cycle or the sales cycle. These are going to be the documents that are going to be driving the sales cycle. Remember that QuickBooks, everything you enter into QuickBooks, typically if it's a normal business transaction, something that happens on a day-to-day basis, it's going to be driven by forms. So we're going to have to set up these forms. How do we put these forms together? Once they are set up, then we're going to use these forms to drive through the process, and the data input of the forms at that point should be an easier process. So the difficult thing about QuickBooks is really getting it set up, typically to get the forms set up in the correct way. You want to get it set up so that data input can be done by someone who doesn't need to know a whole lot about accounting or the software. They can put in the data, and then we'll generate the reports, and then of course interpreting that information. So for the customer section, we have the main things that happens, whether you're a service company or a company that sells inventory. You've got the two things that are typically going to happen. We got to create an invoice, then a receive payment, then record deposit. That's typically the process that will happen in something like a service business. Now note there's a couple different types of businesses in terms of when we're going to get paid. We may get paid at the same time that we do the work, or we typically might do the work before we get paid in something like a law firm or a CPA firm or other type of like a landscaping or services. We might do the work, then have to charge the hours and then bill the client. And so that would be a typical case. And in some cases, we might get paid before we do the work. And we won't go over that scenario here, but something like we have concerts or something like that. We may get paid from getting ticket sales before we actually provide the concert, and that's a bit more of an unusual circumstance in terms of most businesses where we get paid either before we do the work or at the same time. If we do the work before we get paid, we invoice the client, and then we expect to get paid in the mail with a check or something like that. This would be the normal flow that we would have. We'd have an invoice that we would create. We'd say, hey, this is the hours that we spent. If we're a law firm or a CPA firm, here's the invoice that we're going to mail to you based on these hours for the amounts that we are charging you. We would then expect to receive a payment in the mail. We're going to receive funds for that, and then we're going to take those and we're going to put them into the bank. So note the banking system here isn't really part of the customer section, but there's a little arrow that goes to the banking system because hopefully most of the deposits we make are from customers. Not all of them will be, because we're gonna have we might put more money into the system, into our business, or we might get a loan or something like that. But hopefully most of our deposits are part of the customer section. So that's going to be the normal process we'll have here. We'll talk a little bit more about the journal entries when we make these items, when we go through this, and when we actually do this in practice, and we'll talk more about how the financial statements will be affected. Then if we get paid at the same time as the point in time we do the work, then we're going to create a sales receipt. And it sounds just like what it is. Basically, we're going to say that we're creating a sales receipt, which you can think of something that we would give to the customer at the point in time that they check something out. For example, we're going to be selling guitars. If they were to bring a guitar up to the front of the store and say, I want this guitar, here's the sticker price, rather than create an invoice, which would create an IOU, we would just create a sales receipt, and note that that bypasses these two items. We wouldn't have to create an invoice, we wouldn't have to receive payment, because we're going to record the sale and receive payment at the same point in time, that being the point in time that we create the sales receipt. And then that would go directly to the record deposit. Those are going to be the main kind of components that we're going to be looking at within the customer section. That flow, that process, that's the main thing we want to get down or understand when we take a look at these processes. Let's take a look at those same items within QuickBooks Online. Here we are with QuickBooks Online. We don't have that same flowchart, but we do have all that same information, and typically one place to go is this little plus item up top, and that'll give us a grouping of our activities. We saw by vendor before, now by customer. So we can see these activities, and we can see the same kind of, think of that flowchart as we're entering these activities. We're just going to go through the main ones here. We're not going to go through everything, but we're just going to go through the main things that we're going to use within this cycle. And that would be us billing clients, us receiving payment, and then making the deposit. So typically, once again, if we were to bill the client and for work that was done for which we had not yet been paid, we would then create an invoice. So here's the invoice under the customer section. If we select that item, we get to an invoice. The invoice is going to have the customer up top. We could email, so this is an optional field if we want to email the invoice. The billing address, the terms of the invoice date, shipping if needed, and then we typically have the product. This is going to be what we sell. In our case, if we're selling guitars, it'll be a guitar that we sell. And if it is a service item, then it'll be a service item. So if we have guitar lessons that we have a service item, it will be here. We have the sales tax and then the total amount due. Now, to actually populate this invoice, not too difficult typically. We want anybody to be able to populate the invoice. But we will go over what the invoice actually does, how to set up the invoice, which is a little bit more difficult, especially how to set up items, and then how to interpret what the invoice is doing, which again is a little bit more difficult. So we'll talk a little bit about that now, but as we go through the process, we'll get into more, well, what's the effect on the financial statement when you create an invoice? How do you enter the items? How do you set up the invoice so that it's ready to be data input by anybody who's basically working the staff, possibly at a store or whatever at a given point in time. So the invoice itself is going to increase, it means it's going to increase accounts receivable. So an invoice is going to increase accounts receivable. The other side is going to go to sales or revenue. So in our case, we'll have revenue here. If we sell guitars, which is a service, well, first, if we don't have guitars, if we're just selling a service item, such as guitar lessons, that's basically it. Accounts receivable goes up, and we credit sales or revenue or income, and we expect to receive payment in the future in the mail. If we sell something like a guitar or something like that, inventory, then we're also going to have sales tax, possibly, depending on the region that we are in, or usage tax, some type of tax based on that sale, and therefore we'd have to actually add the sales tax for whatever region we're in. We'll talk a bit about that as we enter data, and that would give us the total amount due. So the debit to accounts receivable would include both the sales price and the sales tax. The credit or the increase in sales would only be for the sales price, and the difference would go to a payable for the sales tax payable. So that would be to record the sale, and then the other side would be a decrease in inventory because we sold inventory, in this case a guitar, and the related cost of goods sold. So that journal entry, you can see it's a bit more complicated than you might think when just putting the data input. So there's two things we want to learn here. One, how to just put the data input into the system. Two, how to set up the system so data input can be done well. And three, how to interpret what is happening when we put the data into the system to the financial statements, to the end result, to the decision-making documents. We're going to close this back out and then take a look at the next component. If we hit this plus item once again, we're going to go back over here. So we have the invoice, and then we're going to receive payment. So remember, the invoice increases accounts receivable, but we have not yet gotten paid. Then we'll go to receive payments. And if we go to receive payments, then we're going to enter the customer once again that we have received the payment from. And that'll typically give us an option of the invoices related to that customer. And we can then go in there and check off any invoices. I've picked a customer just as a demonstration. If you don't have anything in here, of course, then that's okay. It's just a demonstration. So if I pick a particular customer, typically it'll pull up the invoice. It'll say, hey, this is an invoice you have for this customer. Do you want to connect this payment to this invoice? If we do so, then it'll put the payment here and it'll tie those two things out. So if we got $950 in the mail and it was related to, well, we got it from Diana Martinez, and we assume, of course, it's for this invoice as the system just pulled up for us, then the system will apply these out. What will the effect be on the financial statements? It's going to increase the amount of money we got, and it's going to decrease the receivable that's owed to us by Diana. Now, typically, you would think we'd put this into the cash account if you're thinking about normal bookkeeping or normal like accounting textbook problem. We put this into cash, and that still goes into cash, but we might not put it into the checking account yet because we might want to group the checking account in accordance with how we're going to deposit into the bank. Meaning, if we got more than one cash deposit today, more than one check, then we might want to group those together and go to the bank and put them all in the bank at the end of the day. And to do that, if we want to group them in the same format and put them all in the same grouping. So but instead of just putting it directly into the bank now, we're going to put it into undeposited funds. And then at the end of the day, we'll put all the checks into the bank at the same point in time and group them together in the format that they should be grouped. So this is actually increasing kind of a cash account. It is a cash account in a way, but undeposited funds and not the checking account, which is our major cash account. So this is an in-between step that you may not see in a lot of theory classes, which just basically say cash is just this cash that picks up everything. Okay, so we're going to close this back out. And then we'll take a look at the last component of that particular cycle. And we're in the customer. So I hit the plus icon up here. We're in the customer section. So we have the invoice and then the receive payment. And then we go over here and remember when the flowchart had the make deposit. That's going to be the next item here. But we don't see the deposit in the customer section. It's over here in the other section. In the desktop version in the home page, it was in the banking section. And again, we hope this deposit really is kind of related to the customers, hopefully, because that's going to be part of our normal process. We're going to do work and we're going to get money and then we're going to deposit that money. So hopefully this bank deposit is really part of the flowchart under the customer section. However, of course, there are other times when we might make deposits. We might put money into the bank from our personal checking account, which would be a deposit, or we might get a loan, which would be a deposit. But the majority of our deposits should be hopefully part of the accounts receivable or sales cycle. So then we're going to say deposit here. And if we had any deposits outstanding, then we could check those off. They'll actually say, hey, you got this in the undeposited funds right here. Would you like to check that off? And is that going to be grouped together as you go to the bank and deposit this out? If there's more than one of these, if we have multiple checks that we received and recorded as received payments, then we can check multiple deposits off and then go to the bank and put them all in the bank in the same grouping as will be shown on the bank statement, and that'll really help with our bank reconciliation. So the deposit then will deposit into our checking account. So now the actual checking account would be increasing, and that in-between account, those undeposited funds account, that cash account that represents money that we have, cash or checks typically, that we have not yet put into the bank. So that's going to go down and the checking account is going to go up. That's the normal cycle for when we make sales on account. I just closed that out. I X'd that out. Now, the other side that could happen is if we make, I'm going to hit this plus item one more time. Well, maybe not one more time, but another time. If the other item we could have is that if we get paid at the same point in time, remember that flow chart, remember the flow chart for the desktop version. If we got paid at the same point in time, if you bought the guitar and someone bought a guitar and they come up and want to ring it out right at that point in time and pay us at that point in time, then we wouldn't do an invoice because that would go into accounts receivable, but we would be doing a sales receipt. So then we'd have the sales receipt here, which is just what it sounds like. We're basically going to process this transaction and provide a sales receipt at the point in time of the transaction. If we select that item, then we'll see the sales receipt looks very similar to the invoice. However, it will say sales receipt, and when it does so, it means that we're going to increase some type of cash account. So in our case, it will be the undeposited funds. We're going to put the money into undeposited funds once again, rather than the checking account, thinking that we're getting money either in the cash register or we're getting some check that will later deposit at the end of the day. So then we'd go through here, we'd have the customer, we'd have the billing process, the shipping, the payment method, because we're actually going to get paid this time, typically cash or check. And then we'll put that in and it could be obviously a credit card too, but then we may have to deal with the credit card a bit differently. We might not put it into the undeposited funds because we're going to have a different type of grouping process. If we have cash or check, then we'll do the same process that we saw before on the receive payments, put it into undeposited funds so that it will then be grouped together as we go to the bank at the end of the day and deposit all the funds we have. Then we've got the product that's going to be our service item if we did something like the guitar lessons, or the inventory items if we sold something like a guitar for inventory. Then, of course, we would have the sale would increase. We've got the sales tax that would be calculated if we're subject to sales tax depending on the region. For our purposes, we're going to use just a normal flat rate of 5%. The sales tax or usage tax is going to be something that wherever you're at, whatever the tax rate is, it's pretty easy to calculate. That's the nice thing about sales tax or usage tax. It's all, whatever the rate is, you just multiply it times the amount. So we're just going to use a 5% for a general problem and then add that together to see how that tracks the usage tax, which is actually the more confusing component. How do you track it? How do you pay it out at a later time without getting in any trouble here? So we're going to increase the sales tax. We're going to get the total amount here, and that'll give us a similar journal entry. We got, instead of accounts receivable, the similar journal entry as the invoice, I should say, except that instead of increasing accounts receivable, we're increasing cash, or more specifically, the undeposited funds. We'll credit then revenue, income, or sales, all same type of account, revenue type of accounts, by the amount that we billed, not including the sales tax. Then we'll actually increase and credit the sales tax payable account. And if you don't know debits and credits, we don't have to know debits and credits really. If you do, we'll talk a little bit about the debits and credits, but we're going to try to talk more in increases and decreases and look at the financial statements. When we get to adjusting processes, we will talk about debits and credits to do adjusting entries. But if you can look at things in terms of debits and credits, that's great. If you can't, then we're going to talk in terms of plus and minuses too. So that'll be okay. And then the other side of this will, of course, be that inventory will go down and that the cost of goods sold will go up. So you can see, once again, this is something that this sales receipt is basically something that's created at the check register, and basically the machine pretty much does it most of the time when we're checking things out at a store and getting the receipt. However, the calculation, what's happening, is actually fairly complex. You can see this journal entry is not the most simple of journal entries that we're talking about when we create this simple sales receipt. What we're going to do is think about how to set up the sales receipt to have it be a simple process like that so anybody can do it, and talk about what the sales receipt will be doing in terms of the effect on the financial statements as we make these, because the financial statements are what we're going to use to make decisions. So then we're going to close this back out. And then the next process, of course, if we select the drop down once again, we're in the customer section. If we had a sales receipt, then of course we would go over to the deposit once again and deposit at the end of the day. So the deposits then will include anything that we invoiced and then received payment for in a particular day, as well as any sales receipts we had for the particular day, because those would result in cash and checks which have not yet gone to the bank, and then we would take those, go to the bank, and group them together and deposit them with the bank deposit. That's going to be the typical process. Now, the other section that relates to this cycle is going to be the sales section on the left side. So if we look at the sales section, just to take a look at what we have included in here, the first tab, we have a few tabs up top, is going to be all sales. And this will give us kind of the activity that will be related to this cycle, including invoices, journal entries we'll talk about later, mainly invoices. We've got payments here, and then billable expense. We'll talk about how to have a billable expense and invoice your clients on that, and sales receipts. So this is the activity that you'll basically see. It's kind of like a general ledger that they're giving us here. They're giving us all the transactions that are related to the sales cycle, or the account receivable cycle, or the customer cycle, or however you want to see it. So this could be a useful field for us to go in. It gives us some options such as receive payment and whatnot for particular items, and kind of adjust items. We can get to the same information. It's basically kind of a general ledger type of activity, but it gives us all the activity related to the cycle rather than just one account like the sales account or the receivables account. So that's going to be that item. We have some filtering options and some batching options that we can take a look at. I'm going to go to the second area here, to the invoices. So we saw that where we can create an invoice up top, if we select this plus item, we can create an invoice. We also have some items down here that we can create a new invoice here. And if we wanted to search through our invoices, this is a useful area that we can go through and search through our invoices, and we can try to find these invoices by number, by past due, by date. And we have, of course, some action items that we can have here, including send, print, and view and edit the items here. So another useful place for us to kind of get to an invoice a little bit more quickly than possibly go into the financial statements and looking at the general ledger and trying to find the invoice in that format. And then we have the customers up top. If we scroll up top to the customers, that's going to give us information about our customers. This is, of course, who we sell to. So it's going to be an important list that we have here. It's formatted this way. We can go to these customers and we can create something like an invoice to directly that customer. The benefit of creating an invoice here, other than just hitting the plus item up here and creating an invoice, is basically that we'll just generate the customer and we won't have to fill in that field. So it might be a little bit faster in that format to do that. We can have the new item up here, which is basically a new customers that we can be setting up here if we wanted to add customers as we go. We can add customers as we create invoices as well, which is nice. So when we create the invoice, we can put in a new customer in that process. And we'll of course have the customer balances here. So it'll give us some detail that we might otherwise would need to basically run a report in order to get that detail. So then we have the products and services tab up top in the sales area. We'll talk about how to set this up. This is probably one of the more confusing areas to set up. People that aren't used to setting this up. This is what we need to set up in order to make those sales receipts and those invoices easy to use. So to do this, we're going to set up the inventory items. We're going to set up the guitars that we're going to sell. And then whoever puts in the invoice or the sales receipt then can just pick the guitar that we sold with the sticker price on it. And the system will know what the cost is and what the sales price, and it'll be able to calculate everything that way. Same with service items. If we do guitar lessons or something like that, we'll set up the hourly rate for the guitar lessons, and then all we have to do to make the invoice is just to know how many hours we have and just pick that service rate, and it'll create the invoice for us. So this is really one of the driving components that we need to get put together in order for the normal process, the day-to-day just data input, to run smoothly. So those are going to be the major components of the customer process. We'll go through how to set all these up, and we'll go through how to run through recording these items within the customers or the accounts receivable or the sales cycle.